Hey, welcome back, everybody, for our DeFi panel. We have a great group of panelists here with startup founders in DeFi, which is great. We have Chandra Duggirala, who's the co-founder of Portal, which is DeFi on Bitcoin, and he's going to talk about that, as well as Alec Shaw with Sperax, which is an algorithmic stablecoin that Tarek just spoke about, so we'll get into conversations about that. And Kennelly is the founder of Volmex, which is a derivatives DeFi application. So I think Chandra, you can go first, and you can share your presentation, and we'll go ahead and watch you. And 3 to 5 minutes, and then we'll go around each with a different topic. So
amazing.
All right.
Hope everybody can see the screen. Thank you very much, June. Great event. Congratulations. Wonderful talks. My name is Chandra. I am the co-founder of a company called Portal, and we build DeFi products on top of Bitcoin. So thanks for this opportunity. Hello, everybody. So when we talk about DeFi or DeFi on Bitcoin, real DeFi, in our view, supports uncensorable, unstoppable finance. What this means is that people can transfer value or ownership of a unique piece of digital property to one another, so that it's trivially expensive to verify, it's public, it's transparent, and it's irreversible without the consent of the two parties involved in the transaction. It also means that people can enter into voluntary contracts of arbitrary financial complexity with each other, and they can trust that the terms of the contract are enforced consistently and irreversibly. All of these are exchanged through a distributed web of trust, which is Bitcoin in our view. And none of these transfers actually rely on a centralized intermediary like a bank or a broker. Unfortunately, we're a long way from that. DeFi today is packed to the gills with complexity, obscure jargon, opaque scams, and poorly thought out schemes. And so we think building the peer-to-peer finance or decentralized finance on anything but Bitcoin is not very secure, and pseudo-decentralized alternatives and poorly designed and thought out blockchains is similar to building castles on sand. Of course, we talk our book. We believe Bitcoin is the perfect settlement layer. It is the perfect way to build fully collateralized peer-to-peer lending and borrowing of digital assets enforced by on-chain contracts, whether the transactions actually happen on layer 1 or layer 2. We think stablecoins, fully pegged, redeemable, frictionless redeemable stablecoins issued on Bitcoin sidechains that are transparently centralized is the way to go. We think that allows us to do peer-to-peer Bitcoin to stablecoin swaps, options, futures, derivatives, and then onto cross-chain instruments with all of the surviving surviving blockchains. And then we can go on to the next level of entanglement with the physical world. You can transfer deeds and secure property titles using the infrastructure built on top of Bitcoin as the connectivity layer. So therefore, we're building digital capital markets on top of Bitcoin. It doesn't stop with options. It doesn't stop with futures. It doesn't stop with perpetual swaps. You can build any arbitrarily complex financial contract to be exchangeable and traded freely and peer-to-peer on top of Bitcoin on many layers. And we don't make any representations about the layer 2 or layer 3 stuff actually inheriting the full properties of the layer 1 Bitcoin. If it doesn't, there's no way to do it, but that's okay. Different layers of centralization is okay. It just needs to be transparent to the end user without any obscurity. And we believe that the best user interface for people to interact with these decentralized peer-to-peer financial instruments is through their wallet. Of course, interface design has taken a backseat to engineering in the crypto space, but that actually has come around now. And once that's done, we see a world where we can seamlessly share liquidity across chains with a simple end user experience. We can even seamlessly aggregate liquidity across many chains and reduce the fragmentation. We can offer things that work in the background reliably without the users having to go through multiple different DeFi protocols or instruments. Like atomic KMMs can aggregate liquidity seamlessly across different chains. What this actually promises is if you have, you can now start to attack the biggest markets the world has ever seen, the foreign exchange markets. If you have fully collateralized redeemable stablecoins in multiple different fiat currencies, you can use this infrastructure to actually build or to do instant settlement, low-cost foreign exchange transactions. And then you can go on to do the final step, which is Bitcoin native financial instruments such as hash rate futures, energy futures, and derivatives for miners, as well as other institutions looking to do neutral reserve assets to their balance sheets, which we believe is coming. And like I said, physical property entanglement with deeds and property titles. So overall, we actually believe that the future of DeFi is really bright on top of Bitcoin. And happy to join the panel to discuss more. That's it for me.
Hey, thanks. Thanks, Chandra. So yeah, so Cole and Alec, maybe it's good to have your follow up on this, because this is DeFi on Bitcoin, and I think you probably are working on projects on Ethereum or outside, right? So any questions or follow ups to kind of this idea that, hey, Bitcoin should be the settlement layer? And in some context, I guess Terra was buying Bitcoin as a collateral for their algorithmic stablecoin, and that got a lot of traction. So there is some sentiment that Bitcoin is the most the highest quality settlement layer. So Cole or Alec, do you want to you have any comments on that?
I think Bitcoin is definitely a great collateral for DeFi. I think there's definitely more, some stuff being built out these days on the Bitcoin, network in terms of DeFi, but it's definitely a good collateral asset, certainly. So, yeah, definitely think it makes sense. It's very interesting presentation there.
Thank you, Will.
Yeah, I just have a quick comment. So I totally second that Bitcoin is a great collateral asset, but something you mentioned was the transparency component, which is so fundamental when it comes to things like liquidations. You can have a bunch of Bitcoin backing an asset, but the way in which it gets liquidated may not be transparent. So I think it's very important, as Chandra mentioned, having transparency on those layers to give insight into things like liquidation or the levels of collateral that are actually sitting on chain ready to be liquidated is the missing piece of the puzzle. So Bitcoin is great, but also the transparent connection to a liquidation process is equally as important.
I fully agree. Proof of reserves and other ways of actually proving what actually backs these issued tokens is very important. I think it's a necessary step, maybe not enough, but yeah, great. We're on the way to what Alec is describing.
All right, sounds great. So, all right, so let's go on to the next, and then we'll, if there's any other questions on DeFi on Bitcoin, and then we'll kind of move on to, I think, who's next? Is it Cole or Alec wants to go next? Okay, Cole.
I can go next. Thanks,
okay,
Jun. Awesome, yeah. So really great to be here. Thanks, Jun and the WCEF team for inviting us. This is Cole Kennelly, founder and CEO of Volmex Labs, where we're building a suite of crypto volatility products. So today I'm going to be giving a brief overview of the crypto derivatives market today, and to discuss a bit of what we're building at Volmex. So the largest crypto derivative today is still the perpetual swap, or the perp. So, over the last 24 hours, there's been about 40 billion USD in trading volume. on the top 10 perp exchanges or perp markets, and there's about 14 billion currently of open interest across those markets as well. The leading perp exchanges are a bunch of number of centralized exchanges like Bybit, FTX, Binance, etc. The crypto options market is still a bit smaller. So there's currently 8 billion of Bitcoin open interest, about 5 billion of ETH open interest, about 620 million of Bitcoin options volume has traded over the last 24 hours, 300 million or so of ETH options volume. The largest exchanges are still centralized exchanges like Deribit, which has a lot of market share, and then OKX. There's also a burgeoning DeFi option vault market with some of these different products coming to market in the last few months. And then the crypto volatility product market has been taking shape over the last few months with some of the stuff we're working on at Volmex and generally. So we expect this to be a big segment of the market in the DeFi derivative space to grow as well. So generally, I think I've discussed a few different segments of the crypto derivatives market. One major trend to look out for is kind of the moving from centralized derivatives, CeFi, to DeFi derivatives and DeFi protocols. So DeFi obviously has no counterparty risk, no minimums and maximums, and a number of other benefits compared to CeFi. So that's generally on the landscape today and kind of how we view the crypto derivatives landscape. I also want to talk really briefly about Volmex and kind of what we're doing at Volmex. So I have a super quick few slides. So I think you guys can see my screen, correct?
Yeah.
Cool. So we're building crypto volatility products at Volmex, a suite of different products. Crypto is an extremely volatile asset, so this is a really necessary product. We are building some indexes like VIX-like indexes and different products around it, so a suite of different derivatives. It's a massive opportunity because obviously in TradFi, crypto derivatives, or excuse me, VIX derivatives and futures and options are a massive industry, and then of course, that's going to be quite a large market in crypto. So we have very high conviction that this will be a super material market in the coming years. So the VIX market is massive in the TradFi space. We think the crypto VIX and volatility index market will grow into this. Ultimately, crypto vol products and a lot of other derivatives are an easier way to trade certain types of exposures. So it's a single tradable product, and it's which allows people to gain leverage in a capital efficient way generally, or express a view that otherwise they can't express. So there's a number of use cases for derivatives and Volmex products. So hedging, speculation, going long short as a market indicator, and decentralized derivatives and decentralized volatility products are composable, they're accessible, low fees, and transparent and secure. So there's a number of benefits to DeFi derivatives and DeFi vol products. And, just a little bit about our index, the Volmex Bitcoin Volatility Index, Volmex Ethereum Volatility Index. And, here's a screenshot of the index. And then here's a screenshot of one of our first products. So really awesome to be here. Looking forward to the panel and, looking forward to talking more about DeFi derivatives. It's a really exciting space and there's a lot to talk about.
All right. Thanks a lot, Cole. Alec or Chandra, anything to ask for Cole? Any questions, or what are your thoughts about the derivatives market right now?
I'm assuming that this is CFTC regulated in the US?
No, this is a DeFi derivatives product that's we actually geo-block some jurisdictions, and in the US, unfortunately, one of them right now. So based on our terms of service. So publicly available protocol, but the kind of UI is geo-blocking certain jurisdictions. But we'll have to work towards that. And so it's a DeFi derivatives protocol, not TradFi.
I have a quick question. Have you ran into any challenges with the cost of on-chain computation when it comes to these complex products?
Great question, Alex. So I think, over the last year or a year and a half, Polygon and some of the other scaling solutions or layer twos have been really big for Ethereum and more or less before these really came to the market. I think DeFi derivatives was kind of not feasible on layer one, or it was barely feasible for a while. It was feasible for a little while, and then the fees got really expensive. So at Volmex, we view a low fee and a fast confirmation as really critical to the user experience. So we think that tech like Polygon POS chain and like some of the ZK stuff coming generally is really important and is really critical for like a good user experience. So that's a great question around kind of we think that it's really important to have like kind of a good environment to do that. And yeah, a lot of this stuff would be too complicated for mainnet. It's really important to have like a layer 2 or something like that. So great question. Definitely think that that's a going to be an important trend.
All right, great. All right. So any other questions? And maybe we'll just get Alex to present on algorithmic stablecoins. Seems to be a hot topic as well. So yeah. Let's give the floor to Alex.
Cool. All right, just confirming you all can see this. Yes?
Yep.
Sounds good. So thank you everyone for tuning in, and thank you to my other panelists as well as WCEF for hosting tonight. I've really enjoyed it thus far, and I'm looking forward to the panel. But I'm Alec, and I am the partner of growth at Sperax. And Sperax is a software development company with the mission of connecting you with modern money. And we actually believe that modern money already exists, yet it's extremely challenging to access. And once you do access it, it's very confusing, intimidating, and just basically challenging. So we've set out to automate both the financial complexity component as well as the crypto technology complexity associated. So we view those as the two main barriers: financial expertise and technology expertise. That's why we believe popular layer 1 protocols like Aave, Compound, and Curve have yet to break even 1,000 daily active users. So first, when it comes to the financial automation, what we've done is created the Sperax USD protocol. So it's a decentralized, fully backed stablecoin protocol that automates yield-bearing strategies. So it is a stablecoin itself, but what it is actually a basket of other stablecoins that are generating yield, and then that yield is passed to the end user in a fashion that doesn't require any staking nor claiming of these rewards. So let me explain how it works under the hood just really briefly. So if you're a user, you're hanging on to USDC, you don't really know what to do with it, but you heard that DeFi can deliver you high interest. So what you do with your USDC, you deposit it into the Sperax USD protocol, and out comes a freshly minted USDS. So what's very important to note is for every USDS out in the market, there's one USDC or USDT sitting in the reserves. And the best part about this USDC and USDT sitting in the reserves, it enables the end user who's holding this new stablecoin to have faith that it will not depeg. So the phenomenon that happened to Terra and UST can't happen to the USDS stablecoin. This is simply because in the event that there is even the slightest deviation from the peg, hypothetically, USDS is trading at 95 cents. Anyone can go grab USDS, go to our website, or go to the protocol directly, burn their USDS, and they'll be given one USDC or USDT, whichever one they choose. And the coolest part is that, you know, this collateral that's sitting in the reserves protecting the $1 peg is also used to generate passive income. So every single USDC and USDT sitting in the reserves are deployed into various yield-bearing strategies. So we elect the safest and the most secure strategies to generate the yield. Right now we're using Curve. So the stablecoins go and generate yield, and then they're passed down to the end USDS holder without having to stake, without having to claim. So there you go. The financial component is automated. But at the end of the day, it's still really challenging to interact with crypto as a whole, right? Maybe for everyone here, it's kind of simple. Public, private keys, sure. But for most people that I know, public and private key means nothing. So how do they harness the power of modern money? And we believe that it actually takes partnerships with fintech companies. So we're a decentralized on-chain protocol, but what we do is we power various fintech products. So we just signed a partnership with StreetBeat. The product went live on Monday. We already have 500 new users with an average deposit of $1,000, harnessing the power of DeFi through a familiar user interface that they're used to. And we actually took this from the Bankless podcast, but this idea of having DeFi in the back and fintech in the front is called the DeFi mullet. So these DeFi protocols, we believe, will power fintech products and neobanks, but the end user likely won't have to deal with the crypto component themselves. So that's Sperax. We're a fully backed, 100% collateralized stablecoin that automates yield-bearing strategies for the end user. And we partner with fintech companies to make accessing this even easier. So that's Sperax in a nutshell, and I look forward to the panel. Thank you for having me, everyone.
Great. Yeah, so that's great. Any questions, Cole? Or whoops, I got the wrong. Get Chandra back here. Hey, Chandra. So yeah, any questions for Alec, Cole, or Chandra?
Yeah, sure. Great presentation, Alec, and congrats on launching. The question I had is, do you guys buy the Tether and USDC on the open market, or how does the collateralization, is it contract automated?
Correct. So a user holding USDC or USDT who is seeking yield can deposit the collateral into the protocol, mint USDS, but the collateral that's deposited is then sent to Curve to generate yield, and that yield will be passed back to the USDS holder. And something important to note is that only USDS in user wallets are eligible for this yield installment. So that's how we're actually able to produce an 11% return, because not every single USDS is eligible for the yield installments.
Got it. Thank you.
All right. So yeah, we're running out of time, but I think let's kind of just ask a few questions on I guess stable coins and Curve. Maybe is the first question, just because it follows up on what Alec just talked about, and then maybe final thoughts on UST and the their design for the algorithmic stable coin. So I think Alec, this is a far different design than the UST algo stable coin. Mm-hmm. It is collateralized though with Tether and USDC. So I don't know if you guys want to comment, maybe starting with Alec, just the idea of, okay, well, what about USDT is the question, and what are your thoughts on algorithmic stable coins like UST? Or maybe we'll just kind of wrap up with those two questions for everybody.
Sure, I'll start real fast. So I think that there is a spectrum of risk when it comes to algorithmic stablecoins. The most risky would be a UST model that is collateralized exclusively with a governance token. These models work extremely well in up markets, but the second there's a down market, you start running into under collateralization challenges. No one wants to redeem the stablecoin because what they're going to get is a governance token that's declining in value very rapidly. So you can actually you can build safer stablecoin protocols. And the way you make them safer is you introduce collateral that is unrelated to the health of the protocol itself. So we've gone the farthest on the opposite end of that spectrum. So we've gone 100% collateral, all unrelated to the Sperax ecosystem. So at any given point, one can swap a USDS for a USDC. And then there are protocols that sit in the middle, like Frax, that is partially collateralized by their governance token and partially collateralized by explicit collateral. And I think that the market is going to demand various different flavors. And there are different risks and different trade-offs when you pick this collateral ratio. And I think that there's plenty of room in the market for many different collateral targets. And I look forward to figuring out how our DAO sets the collateral ratio, because you can go risk on, you get more growth, but you sacrifice potential peg stability. So it's a very interesting arena to be playing in. And there'll be many competitors with many different risk profiles in the coming months.
All right, sounds good, Alec. Cole or Chandra, UST, fiat-backed stablecoins, and then also algo stablecoins like UST. Any comments or thoughts?
Oh, sure, go ahead.
Okay, thank you. So I don't think algorithmic stability can be achieved at all. You can, for brief spurts and moments in time, achieve stability, quote unquote, within a range of prices, exchange prices. Nobody can read the prices of goods in the future. That requires you to read human minds from the future. That's just nonsense. What I do like about Alec's presentation is that it is fully collateralized by unrelated assets, right? And those assets are freely floating against USD. But as long as they're full collateral that is transparently visible and frictionless convertibility or redeemability between your stablecoin and the underlying asset, that's good enough. That's all you need. In a way, it's a reinvention of the bank model. Fractional collateral is exactly what we do now in the TradFi system, right? Banks have a reserve ratio. They deposit like whatever, $9 at the Fed, and they can loan out X amount in loans. Of course, loans have a different risk profile in terms of how good they will be. And there's nothing wrong with that. So as long as it's transparent to the end user what it is that they're getting, I think that there's nothing wrong with it. Naming the algorithmic coins as stable coins actually, I think, does a lot of disservice to the end user. So that's my opinion on it. But
okay, sounds great. Yeah, good take. Cole, any thoughts?
So it's an interesting topic. There's kind of a spectrum, I think, like Alex said, like of algorithmic stablecoins, but specifically with Terra, I mean, the issue was that it was only backed by Luna, and they tried to buy themselves some time, but with this LFG, foundation and get some Bitcoin, backing it, and try to diversify away from only Luna, but it wasn't, enough. So I think Maker is really the most far along with this kind of portfolio of uncorrelated assets that are backing DAI. So there's like USDC. There's like some, it's kind of a contested, I guess, topic, but there's like some real world assets, and there's other things. So they have this. So I think generally, it's very clear how there can be a death spiral if you back up tons of value with a governance token, which is thinly traded, and then kind of pretty, I guess, interesting situation of, kind of monitoring it. But I'm not sure if algorithmic stablecoins can work. I definitely think it's possible. DAI's been pretty stable. I think, again, like algorithmic stablecoin is kind of broad term, there's all sorts of things. So I think definitely there's, stable coins that are not just one-to-one fiat collateralized that can be stable, but, we're working on DeFi derivatives. I think there's other teams, which like Alec's team and other teams, which are doing that, like Maker and stuff. So, I think it's a really interesting space, but, the Terra was a pretty big, blemish for the space though.
Yeah, and just to make a note that DAI and MakerDAO has a more of a collateralized, over collateralized system, so they wouldn't be considered like an algo stablecoin. So
right.
So one last question, real quick. I'm wondering, since Alec, you mentioned the yield, and I'm always there's this expression that, hey, if you don't know where the yield comes from, you're probably the yield, right? Like, and so where do you get that 11? And Curve, like, how does Curve get, like, why do I see these high yields on Curve? I don't understand where that yield comes from. So any of you guys can answer that, that'll help me out, like just figuring out like how these yields are generated. So
well, let me speak real fast to how our protocol juices the Curve yield, and then if either of you guys want to fill in on how the Curve yield is generated, feel free. But today our pool, our collateral, is sent to a public Curve pool. It's the Curve 2 pool on Arbitrum. It returns about 5% APY. So you might say, okay, well, how the hell are you getting 11% if Curve is only generating 5? Something I mentioned before is very important, which is that the only eligible stablecoins in our protocol are those residing in user wallets. So any stablecoin that's, for example, providing liquidity on Uniswap or providing liquidity on Saddle or in any smart contract is no longer eligible to receive this yield. So today, roughly 20% of the circulating supply of our stable coins are sitting in user wallets. So we collect yield at roughly 5%, but we only owe it to 20% of the holders. So we're actually effectively able to, you can think of it like 5xing that yield and giving it to those users, but we keep everything over 11% in reserve contracts, basically for a rainy day. So in the event that these yields dry up, we have a reserve budget ready to fund that 11%. And then I guess because I'm talking, I'll just fill it in real fast. The Curve positions generate yield because of two sources. First is the trading fees associated with the Curve protocol itself. So if you have one stable coin and you want to trade it for a second stable coin, you're going to pay a very tiny fee on the Curve protocol. That Curve protocol, that fee goes to anyone providing liquidity on the protocol, which is our collateral. And second, the Curve protocol will actually incentivize users to keep their money in the protocol by giving them CRV tokens. So our protocol collects both of those fees, uses those fees to buy more USDS, and deposit it into anyone holding the stable coin in their wallet. So that's how we finance the yield, and it's all organic. There's zero subsidies coming from our protocol, which was one of the key challenges with the Terra protocol. So we wanted to avoid that at all costs. We're all about organic yield over at Sperax.
Okay, sounds good. And Chandra or Cole, any kind of follow up?
I think Alec hit the nail on the head. That was a good explanation of how Curve works and their protocol generally. I think it's a an LP model where the LPs are kind of sharing in the trading fees generally in a pro rata way, and then that yield can be used to do different things.
Yeah, that is and that to me is fundamentally sound. Any kind of trading fees or transaction fees, there is a component that is dependent on the token, right? So, and I think that might just be a little bit more of an issue, I guess, right? Am I reading that correctly, Alec, in terms of the yield?
Yeah, so say hypothetically, the price of CRV is decreasing rapidly, our yields will suffer But the same thing goes in the other way. If people are bidding up CRV to participate in the CRV wars, we'll be enjoying healthier yield. Yeah.
Okay, interesting. Yeah, there seems to be a race for this liquidity and like monopolizing that. But I still think, you know, those yields seem a little too high, just like just on instinct. So, but anyways, Chandra, any kind of last comments? Yeah.
No, I think Alec clarified that yields actually float with demand, right? At the end of the day, someone has to generate the demand. If demand is rapidly decreasing, your yields are going to go down. The demand for curve protocol is actually increasing, then you can see healthier yields. That seems to make sense.
Okay. Great. So thanks so much for the education here. Really appreciate you guys, Alec, Chandra, and Cole. Yeah, well, hope to have you guys back and you know, update us on all your projects. So thanks so much. Really appreciate it.
Thank you, Jun.
Great to be here. Later, guys.
Thanks for having me.
All right, great.